Hello and welcome to our discussion on financial accounting. Today we will understand the determination of ratios after preparing the financial statements from a set of business decisions. For that, let us take an example. Suppose a company AB Limited has the following sources supported by the assets, plant, stock and cash and certain transactions. So we'll first convert these transactions into financial statements, then we calculate the relevant ratios. So the opening balance sheet consists of capital, reserves, creditors, 12% loan as the sources, and the corresponding assets are plant, stock and cash in the ratio of 2:3:1. So the plant is original cost 300,000, accumulated depreciation minus 1,000, stock 300,000, cash 100,000. So opening cash in hand available is 100,000. Now with this opening balance sheet, we'll now prepare the financial statements on the basis of the transactions undertaken by the company. The first transaction is that the company issued 1,000 convertible bonds of 100 at 100. So this is an receipt, 100,000 is a receipt, and convertible bond is a source or a liability on the balance sheet. And what to do with that money? The entire proceeds they've used to buy the shares of X Limited. So purchase the shares of X Limited 100,000, and shares of X Limited is an asset. So the sources will show a new item, that is convertible bonds, and on the assets they will show a new item called the X shares, and the X shares have been purchased from the proceeds of the convertible bonds. Then the next transaction, the depreciation on the plant, 20% on the cost, 20% on the original cost. So we are assuming SLM, straight line method depreciation. So depreciation for the period is 20% of the original cost, and as a result your accumulated depreciation, the accumulated depreciation is now 160,000. No change in the value of the plant, the cost value of the plant, so accumulated depreciation goes up. So the value of the plant, the book value of the plant, let me show here, book value of plant is 140, book value of the plant is 140, and it is given that the fair value of the plant as of the end of the year is 145. Fair value of the plant is 145,000. So fair value is greater than the book value. So the company can revalue the asset, but we'll take an assumption, but our assumption is here no revaluation. So no revaluation. Okay, so no revaluation. So therefore we are not creating any revaluation reserve, and so that 145,000 is not going to affect the balance sheet anyway. Then sold the entire stock for 450,000. So the entire stock sold for COGS and sold for 450,000, and that is for cash, and the stock is no more there because the entire stock is sold. So we can see that here the stock becomes zero because entire stock sold, and the sales is for cash, no debtors because entire sales is for cash. The market price of the share 25, that will be used to calculate the convertible bonds conversion to find the equivalent number of shares to be issued, which we'll use later. declare dividend, but we'll go to the dividend after determining the profit. So since no other expense before interest there, so let us find out the PBIT. So PBIT is equal to 90,000. Interest on bonds, because it is issued at the beginning of the year. Interest on the loan, because we have not paid off the loan. And since no information is given, let us assume that entire interest has been paid off during the year. If you don't pay the interest, create an outstanding liability. So PBT will be 90,000 minus 9,000 minus 12,000 is PBT. And let us assume 30% to be the tax rate, and so therefore tax will be 0.30, and entire tax is assumed to be paid off. So therefore PAT is equal to 69 minus 20,700. Profit after tax is 48,300. At this juncture, we assume that entire PAT is transferred to the reserve. Then we will see what is given. The company is declaring dividend. So the dividend is 20%. If no information given, we calculate the dividend on the opening capital, and in this case the capital is same, so 20,000, 20% on the capital of 100,000. So all the items taken care. Since you have paid of the dividend, so the reserves will come down to that extent. So we can see the change in the reserve. Opening reserve plus PAT minus the dividend, opening reserve plus the current profit minus dividend is a closing reserves. The total of expenses, the total of cash inflows, the total of cash outflows will give us the cash in hand. So cash in hand is an asset. We transfer the cash in hand to the balance sheet. No change in the capital during the year, no change in the loan during the year, no change in the creditor during the year, so the balance sheet tallies. So with the given information here, we converted the opening balance sheet and prepared the income statement cash flow. As a result, we got the closing balance sheet. With this information, we can get some additional information which will be helpful in analyzing the balance sheet. So equity of the company is capital plus reserves. So first year. The second year has gone up because of the current profits and reduced to the extent of the dividend. The number of shares is capital divided by the face value. Since the capital did not change, the number of shares remains same. Capital employed is the capital employed will show the capital plus debt plus convertible bonds. So capital plus reserves plus loan plus bonds. So 500,000 in the first year and 628,000 in the second year. Capital plus bonds, so I can write down this as equity. So equity plus debt plus convertible bonds. The book value per share shows the equity per share. So equity we already calculated here, so divided by 10 is the book value per share. So the book value per share shows that the asset backup or asset minus liabilities available for the shareholders. We'll use the book value per share later in one of our sessions. Now this part of the income statement is called appropriation statement, which will take the opening reserves which was there in the opening reserve. The opening reserves was 300,000. current profit is 48,000. We have declared the dividend of 20,000. So the closing reserve is opening reserve plus PAT minus the dividend, which is same as 328,300, which this is a part of the income statement, but this is called below the line items. Items below the line are appropriations and items above the line are expenses and income. Dividend is an appropriation of profit, whereas the interest is an expense. Dividend is appropriation, whereas the COGS is an expense. So profit is called bottom line, sales is called the top line, the dividend is called the below the line items. Now with this information that we have, we can use to calculate the relevant ratios. The number of ratios that can be calculated depends on the questions that we have. So in this example, we take some relevant ratios of liquidity, solvency, general profitability, and overall profitability. The current ratio of the firm, we are taking it for the closing year. So the current ratio of the firm is the current asset, which is the cash here, only cash because no other current asset, divided by the current liability. So the current asset current ratio is 4.9, and since no other asset is there in the current asset, so the liquid ratio is also 4.9, and the absolute cash ratio is also 4.9, because the only current asset that you have here is the cash. Solvency ratio will tell us about the equity and debt equity ratio. The debt here is long-term debt plus the bonds divided by equity. So the debt equity ratio will show that in this case the debt equity ratio is less than 1, because the company is having more equity finance than the debt finance. Interest coverage ratio, let us define interest coverage ratio is a PBIT by interest. PBIT by interest, and PBIT here is 90,000 divided by interest 9,000 plus 12,000. So it is interest coverage ratio is 4.3. Now debt to total asset, equity to total assets will tell us about how the assets are financed. The debt is long-term debts, which is loans and the creditor and the bonds, divided by total assets. That means we can show like this, that 27%, approximately 27% of the assets are financed by the long-term debts. Where is the balance money coming from? The balance money is coming from the equity and the creditor. So the equity is financing the business to the extent of 59%, and the current liability by total assets is financing the business for the balance assets. Balance is coming from the current liabilities, and so 14% of the assets are financed by current liabilities. 14% is financed by the current liabilities. 59% is financed by equity, and 27% of the assets are financed by the long-term debts, which consist of the loan and the bonds. Now we'll see the profitability ratios. PAT by sales is the profitability ratio. PAT by sales, PAT by sales will tell us what percentage of profit is profit is what percentage of sales. Expenses will show the percentage of expenses to the sales. Expenses here is the COGS plus depreciation plus interest on loan plus the tax divided by sales, and the sales was 450,000. So 89.3% is an expense, which consists of COGS around 67%, depreciation around 13%, impairment 0, interest, both bonds and the loan, interest 9,000 plus 12,000 divided by sales is the remaining expense. So this shows if you want to manage the PAT by sales, if you want to increase PAT by sales, we have to manage the expenses, and expenses here are COGS, depreciation and interest. This shows the income statement items, or which is also called the general profitability. The overall profitability is a variation of different shades of ROI, and ROI can be return on equity, ROI can be return on capital employed, ROI can be EPS too. So the return on equity is a PAT divided by equity is 11.28%. Earning per share is PAT by number of shares around 5. PBIT by capital employed will give us the RO, return on capital employed. Dividend per share, which actually tells us how much dividend has been distributed. EPS shows the profit distributing ability, whereas DPS shows actual profit distributed. But according to Accounting Standard 20, it is also necessary to calculate the diluted EPS. The diluted EPS is equal to adjusted PAT divided by adjusted number of shares. Adjusted number of shares is equal to actual shares, actual plus potential shares. Potential shares is a convertible debentures. In this example, because there are convertible bonds, the potential shares are the convertible bonds which can be converted to shares when they are on the basis of the market price which is given here. So the adjusted number of shares will be actual shares which we calculated, and the potential shares, because the bonds are 100,000, the market price of the share is given as 25. So for every one bond we can issue 4 shares. So therefore the number of potential shares will be this divided by 25. So the number of shares for the purpose of, so I'll call that adjusted shares, which is actual shares plus potential shares. And this number is required to calculate the diluted EPS. But before we calculate diluted EPS, we have to calculate adjusted PAT. Adjusted PAT is equal to PAT plus interest on convertibles, plus interest on convertible, because that will no more the bonds when they are converted, minus the tax benefits, on the interest on the convertible. So that is called adjusted PAT. So adjusted PAT here, we'll take the PAT from the income statement, take the interest on bonds, not interest on loans, and deduct 0.30 into the interest. So 2,700 is the adjusted is a tax on interest, so the tax benefits on interest. So adjusted PAT is 54,700. So the diluted EPS is adjusted PAT divided by adjusted number of shares, which is 3.9. The diluted EPS is 3.9. The basic EPS is 5. So this shows the overall profitability. This shows the general profitability. So given a set of financial statements, it's possible to convert them into the relevant ratios, and these relevant ratios for a particular period, if you observe, then we can understand what decisions this company is taking and which direction the company is heading towards. Thank you very much.